Welcome back to Geoscope, where we decode the forces shaping global trade and technology. Tonight, a single stack of draft letters on President Trump's desk is shaking markets from Washington to Beijing, and testing whether the US can leverage tariffs, tech, and diplomacy all at once. Sources inside the West Wing say a draft order to remove the Federal Reserve chair is already on Trump's desk. The move stems from the president's profound frustration with the central bank's interest rate hikes, which he views as a direct threat to economic growth and his political fortunes. While the Federal Reserve Act allows for a chair's removal for cause, the term has never been legally tested over policy disagreements. Firing a Fed chair for this reason would be an unprecedented shattering of the central bank's century-old independence, a principle designed to insulate monetary policy from short-term political pressures. The mere suggestion sent tremors through financial circles, with analysts warning of catastrophic market volatility and a full-blown crisis of confidence in the U.S. economy. To underscore his seriousness, he even flashed the draft order at a meeting of stunned House Republicans. But before Washington could fully process that internal bombshell, the administration launched something with far more immediate and global consequences. A volley of letters was dispatched to more than 150 countries, unilaterally setting new, non-negotiable tariff rates. This wasn't diplomacy, it was a decree. No talks, no bargaining, just a single blunt rule for everyone. This sweeping action abandoned decades of U.S. trade policy, which relied on painstaking negotiations and multilateral frameworks like the World Trade Organization. Instead, it invoked broad national security justifications, effectively creating a global flat tax on imports, dictated entirely from the Oval Office. And that everyone includes critical partners caught in the crossfire. Consider Taiwan, the linchpin of the global semiconductor supply chain, or India, a burgeoning giant in pharmaceuticals and services. Even a stable, high-value economy like Switzerland's is now exposed. For these nations, and dozens more, billions of dollars in trade hang in the balance. They are facing a fundamental restructuring of their economic relationships with the United States, yet they have no voice, no seat at Trump's table. The mass ultimatum wasn't really about those 150 nations, it was a message to one man, Xi Jinping. Behind the public bluster of sweeping tariffs, a far more intricate and arguably contradictory strategy was being executed in the shadows of the global tech war. This wasn't about broad economic punishment, it was a precision-guided maneuver aimed at the heart of China's technological ambitions. The goal was to reshape the future of artificial intelligence, not with a sledgehammer, but with a scalpel. While allies braced for the economic fallout of new tariffs, the White House quietly granted Nvidia a crucial exemption. The company received permission to resume selling its H20 chip to China, a powerful AI accelerator designed specifically to comply with U.S. export controls. This move was stunning because just weeks earlier these very chips were part of a broader ban enacted on national security grounds. The official concern was that Beijing could leverage advanced silicon for military modernization, surveillance, and to gain an irreversible lead in the AI arms race. The sudden reversal signaled a dramatic pivot in Washington's thinking. The logic behind this pivot was revealed by key administration insiders. According to Trump's AI advisor David Sachs, the primary objective was never to completely erase Chinese technological progress, but to strategically curb the dominance of one specific company, Huawei. A complete blockade, they reasoned, would only accelerate China's drive for self-sufficiency. It would force Chinese tech giants like Baidu and Alibaba to exclusively purchase Huawei's homegrown Ascend AI chips, consolidating Huawei's domestic market and fueling its rise as a formidable state-backed global competitor to Nvidia. The fear was that a total ban would inadvertently create the very monster it was meant to contain. So Washington played a different game. By allowing a compliant, slightly less powerful chip like the H20 back into the market, the U.S. presented Chinese companies with a choice. They could continue buying from a familiar globally leading American supplier, or take a risk on Huawei's developing ecosystem. This calculated move was designed to fragment the Chinese market, slow Huawei's momentum, and critically, keep a U.S. company embedded in the supply chain. It was a gambit to maintain a degree of influence and market access, choosing managed competition over a complete and unpredictable technological schism. The irony is profound. To contain Huawei and prevent the rise of a fully independent Chinese tech sphere, Washington had to reopen the very market it was trying to fence off. It was a tacit admission that a full decoupling was too costly and perhaps strategically unwise. The new doctrine is surgical containment, a high-wire act of realpolitik in the digital age. So, why the sudden pivot in strategy? The simple answer is that the narrative of a collapsing Chinese economy has proven false. Despite significant headwinds from its property sector and local government debt, Beijing has steered its economic ship through choppy waters with surprising resilience. The data tells a compelling story of adaptation. Let's start with trade. Far from stalling, China's export machine is humming. Official customs data for the first half of 2025 shows total exports topping $1.8 trillion, with year-on-year growth for June hitting nearly 6%. But the crucial detail lies in where these goods are going. While direct shipments to the United States have slipped under the weight of tariffs, this has been more than offset by a strategic reorientation. Sales to the ASEAN bloc of Southeast Asian nations have surged, as have exports to Europe and other Belt and Road partners. This isn't just about rerouting, it's a fundamental shift. China is deepening its integration with the global South, creating supply chains less dependent on American consumers. High-tech exports, particularly electric vehicles, solar panels, and lithium-ion batteries, what Beijing calls the new three, are leading this charge. This external strength is mirrored by a solid domestic performance. The economy expanded by a robust 5.4% in the first quarter, with analysts forecasting a similar 5.2% for the second. This pace keeps Beijing on track to hit its annual growth target of around 5%. The much-feared deflationary spiral also failed to materialize. While consumer price inflation remained soft, it never tipped into a negative freefall, thanks to resilient industrial production and a gradual recovery in spending. Faced with this reality, an economy that bends but doesn't break, the old strategy of pure confrontation is yielding diminishing returns. The new approach is one of tactical finesse. Offer Beijing a limited win to secure a broader strategic advantage, effectively punishing everyone else in the process. It's a gambit born from China's unexpected economic endurance. Scott Bessent, Trump's economic whisperer, told Bloomberg the president gains leverage because he's indifferent. If the EU balks, tariffs climb. If Japan hesitates, the letter applies. Canada faces 35% duties on select goods. Brazil, 50% across the board. Even goods routed through Vietnam could see 40% penalties. It's not classic trade policy, it's about forcing alignment. But the math cuts both ways. American companies earned roughly $1.2 trillion from Chinese consumers in 2024, 4 times the US-China trade deficit. iPhones, fast food, razors, sneakers, 7% of S&P 500 revenue comes from China. If Beijing promotes local brands or imposes quiet bans, US earnings could crater. Starbucks learned this as Luckin Coffee rocketed past 20,000 stores in China, while Starbucks stalled under 8,000. Stocks jumped after Nvidia's clearance, its shares rose 5% in a single day. But the deeper signal is contradiction, policy designed to look tough while bending to market pressure. Jensen Huang, Nvidia's CEO, even praised China's AI talent and manufacturing base, a forecast, not flattery. What's unfolding isn't the tariff fight Trump promised. It's a tech Cold War he's trying to manage in secret. Huawei's chip arm is racing toward 5-nanometer designs and Mandarin-trained AI models. US bans have pushed China to accelerate. By trying to freeze Huawei, Washington helped spark its rise. Trump's blanket tariffs start August 1st. A US-China summit deadline looms August 12th. Even if talks succeed, China's role in American supply chains only deepens. Rare earths, graphite, robotics parts, all flow through Beijing. The US is chasing independence by leaning harder on its biggest supplier. Taiwan, linchpin of global semiconductors, hasn't received a tariff exemption. ASEAN states are settling more trade in yuan, hedging against US volatility. Meanwhile, Vietnam reels from the 40% levy on trans-shipped goods, a policy that boosts China's regional exports instead. At home, tariffs risk lifting core inflation just as Trump pressures the Fed to cut rates. Layer in a weaker dollar and import inflation could soar above 25% in key sectors like electronics and auto parts. The strategy pulls prices up while pushing rates down, a tension that can't last. From coffee chains to car makers, from silicon to rare earths, the US is tariffing the supply chain it depends on and the customer base its companies rely upon. Each sanction bends global commerce further away from Washington. As Trump tells reporters, we'll have the last word. China isn't waiting, it's building. The real question, not whether Xi accepts the summit invitation, but whether Trump still controls the game. You've been watching Geoscope. breaking down how tariffs, tech, and diplomacy collide in real time. If you found this useful, hit like, subscribe, and explore our other deep dives into the global economy.